Hey everyone, we want to thank you for joining us. Steve Jackson, I'm the Senior Vice President of Strategic Development and Channel Sales here at PrimePay, and we are thrilled, I am thrilled, that you joined us. Now some of you might have looked at of today's webinar, and maybe you thought, you know, the first 5 people who wins a new Cadillac. I don't know. We didn't run that contest, maybe unfortunately. For you, but we are thrilled to have you for our monthly webinar, as we have generally the first Wednesday of each month. We kind of had to make a little bit here this month. It is indeed not Thursday, it is Thursday, so we are thrilled to have you. The title for today's webinar is Clients for the Excise, or as it's formally called, the Cadillac Tax. And we have prepared some excellent content for you. Before we get into the content here today, I want to just go over some of the logistics of the webinar and how we kind of handle these. Most of you can tell we have muted your lines. We have a lot of folks on the call here today, so very tough to kind of open those up, at least from month to month, just given that volume. But I do want to hear from you. I would love your questions. There is a lot of content to provide today, and through it all, I want you to go ahead and, if you would, go ahead and type your question in that Go to Meeting menu box. And the question, feel free to go ahead and type that in. Now, I may not have an opportunity, and a lot of times I do not have an opportunity to tackle those questions through the webinar. However, as a kind of a key takeaway, provide certainly our broker concierge partners, we the FAQs, and we're going to kind of, you know, pull the list of questions and then provide those answers to you. And so we also are recording the webinar, and that will be showing up for Concierge YouTube channel, so you can view the webinar. And you will get a copy of the presentation slide deck as well. So with that, let's go ahead and begin. We have a lot, and as is my custom, I tend to throw a whole lot there than I maybe should. but at the end of the day, here we have a title here that is, you know, this Excise. We get into some technical guidance as to what this all means. At the end of the day, what I ultimately want to provide to you is a way for you to go to your clients right now and be able to discuss a planning strategy with your client. So as you look at today's agenda, you know, I have this quick, because there was something that had come up here over the beginning of the year, and I thought, you know, it'd just be good to kind of just touch on that here quickly. But as soon as that is done, we're going to dive right into the excise tax. On the basics, talk about which plans are included and who the responsibilities are, you know, for this particular tax. You know, what does it mean even after 2018? You know, how's it going to be calculated? You know, one of the things too that I want to just throw out there is that, you know, things can't, right? It's one thing that we have seen since ACA has been established is that things have changed, things have been delayed, things have been added, things have been subtracted. So I can't sit here and with any certainty that exactly how this tax is laid out today, say that it's going to be laid out and actually activated here in 2018. At the end of the day, though, you have a responsibility, right? Employers need to begin their due diligence to ensure that their strategies are aligning with the specific legislative strategies that they're going to be forced to deal with. So we'll talk about kind of a 3-inning strategy, okay? And I think it'll be good to somewhat lay out some of the things that you can begin doing in 2015, 16, and 17 for this requirement for this in 2018. Along here for the ride. Again, we're not out any Cadillacs today, but we'll be talking about that tax. So to it here. So first thing was just a quick update. You know, it seems one of the last things that employers touch on is amendments or language changes to their plan documents. I'm talking about, this could be ERISA documents. It could be Section 105 plan documents, Section 125 plan documents. Well, it could lend itself just to employee handbooks, right? I mean, just keeping these documents in are very, very important. And the last 30 days, really over since the beginning of the year, this question has come up quite a bit. And I thought it would just take a slide here to just cover this as a quick update. Many of your employer clients do have implemented a Section 25 plan. Maybe it's a premium plan. It could be a full-blown cafeteria plan with a health FSA but many of your employers do have a Section 125 plan. And so one I want to mention, as the healthcare.gov, as the insurance marketplace has now activated, we've got close to, 10 million enrollees now on healthcare.gov. You also have employees that are working for employers that need to make some changes to life events, qualifying events that occur that will them to be taken off the group health plan from employer and be able to then go and enroll in coverage on healthcare.gov, okay? So there were two permissible changes for cafeteria plans. This was issued IRS Notice 2014-55, so just good information to have, 2014-55, created two new permissible election changes. And it basically, what is the premise? It was to permit plan participants to really revoke their plan coverage and elect other minimum essential coverage in the following situations, okay? And we'll cover situations here with you. So if you think about just a standard Section 5 plan, there are what's irrevocability or irrevocable election. Once that employee has made an election, they are pre-taxing their premiums for that benefit, but for a full event, but for that permissible event, you cannot make a change. You have a way to make that that election, right? Whether to get out of that pre-tax election or not. So these permissible election changes within the document are pretty important because it then allows that participant to make that change based on the event that they have. And so this is up to an employer to add this language as part of overall documents. The plans must be amended with this new language, and I'll just show you the two here in a second, no later than 12/31 or the end of 2015 here this year, or it could be later if your plan year rolls into 2016. So you'd have a fiscal 2015 plan year, okay? So it would roll into 2015. But the document would be amended, and one very important is the employee notification is required to make it effective. So not only do you create it and amend the document, you need to provide it to the employees so they can see that big change. So what are those two permissible election changes? First off, the language would surround employees who was expected to average 30 hours of service, okay, per month in a given over the year. That's what they expect to average. But the employee, through maybe some life status event, would prevent them from doing so, but yet they retain eligibility in the group health plan. Well, if status event prevents them from working that 30 hours or more, this language document would permit them then to go off of the group and be able to have that special enrollment in healthcare or the ability to enroll in that other coverage. The second permissible is really allowing an employee eligible to enroll in a qualified health plan that is offered in the marketplace in healthcare.gov during that marketplace's special or the annual or open enrollment period, that they would have. Open enrollment kind of begins What that does is that's a special event, and if this is amended in part of your Section 125 plan, then that employee would be able to go off of the group health plan, okay, stop their pre-tax deductions, group health plan, and be able to go sign up or enroll in coverage under healthcare.gov. So are most employers going to want Wow, a solid majority of your clients have a Section 125, and I'm not even talking about an FSA, just standard premium-only plan, criteria plan, and this language would need to be amended. So certainly if PrimePay is able to earn that, we have the ability certainly language and make those amendments clients, but you will want to talk with your clients about these specific permissible changes, because it does require some activity, and the must be notified to make it the employee must be notified of that amendment. All right, so let's kind of dive in the kind of the Cadillac tax base. You know, you need to understand the fundamentals before you have that employer discussion. And you know, when I think about it, here we are. So next month, March of 2010. The 5-year anniversary. I mean, if you want to celebrate, fine. I don't know if I'll be celebrating. A 5-year anniversary is coming up, right? Here in next month. I mean, 5 years have just blown by. And think about, okay, 3 years, Steve. My client can't get past 3 months or 6 months from now, and you're talking about strategizing for 3 years? Yeah. Yeah. Yeah, that's what I'm talking about, because some fundamental things that you can begin doing with clients today, and some of these take time. You may not want to, at the renewal of 2018, 90 days out from their renewal, automatically go, whoa, we're way out of whack, we're going to do something, and you do something drastic. Wouldn't it be better to take the next 3 years and be able to build a plan that in 2018, based on what we know today of the requirements, we can plan ahead, doing the right things where your employer has impact of that tax more than just making those drastic changes. So let's kind of go here into the fundamentals. I'm going to refer, as it really is called, really in goals, as the Cadillac Tax. So we're going to move with that, but I'm talking about the revenue provision and a significant, at best, that was a part of ACA. Several revenue provisions. I mean, the other provisions included the PCORI fee. You've got the transferable reinsurance fee. There was a very large medical device tax part of this revenue provision, and these revisions were in place in order to be able to scale and accommodate what health of and Obamacare is providing out there to these uninsureds and insureds. So this Cadillac tax, though, as it was really pushed out 8 years from the enactment of the law, it provides for a significant revenue provision. There's significant opportunities for tax revenue here with this Cadillac tax. Okay. Now, I mentioned before that with so many changes that have occurred over the last even 5 years, many ask, well, Steve, really? I mean, is this thing going to stay as it is? Is it really? It's probably delayed. Gosh, I kind of hope all of those. If sitting on your side, our side, we'd love it to be delayed dramatically, but we don't yet. So the best thing we can do is really be able to sit down with our clients and have that due diligence discussion we know today. And so let's plan. So beginning in 2018, this Cadillac tax provision imposes a 40% excise tax, high cost excess benefit. So that's the amount of coverage, the cost of coverage above the threshold. Another thing to keep in mind is that this particular tax is not a deductible form of a business expense, okay? This is a non-deductible expense or tax by the employer. So it is a direct net cost to the employer if they incur a portion or some of this tax. Another thing to just keep in mind, and I'll reiterate here as we go along, is that this tax is determined by the employer. I'm going to mention it a couple different times just about that, you know, so who calculates it? Who's doing what? We've got carriers involved. We've got maybe TPAs involved. We have other benefit administrators involved and employers and plan sponsors. Who on earth is responsible to calculate this thing? Well, the employer is. Okay, so the employer is responsible for managing and really handling the calculation of this tax. Now, I'll give an example of, you know, how it's allocated. So the employer is determining the tax, but that tax isn't necessarily allocated 100% to the employer. Okay. Well, let's kind of figure that out. So there is some allocation among coverage providers of the benefit plans that that employer is offering to its employees. So let's look at the thresholds. So this is these are the current thresholds that are presently listed, at least out here in the within the Act here today. It focuses on self-only coverage and then basically all other coverages. So generally, you know, it's your employee only, and then employee plus one or more fits into the other category. So the two thresholds that are currently listed is for self-only coverage is $10,200, and then for all other coverages $27,500. Now, when this became law, when ACA became law, you know, there was a tremendous amount of conversation about inflation of premium dollars back in 2010 and what that number could end up being in 2018. And even back in 2010, there is and was a real concern about premiums, richer plans that would easily surpass these numbers in 2018, given standard premium medical inflation, you know, that would result, you know, on each renewal for your group plans. So $10,200 for self-only, $27,500 for all other coverage. So what is that coverage? Okay, so the definition, and it's a short one here, and I'm going to go into it here in just a second, but it represents all applicable employer-sponsored coverage. All applicable employer-sponsored coverage. Let's break that down. So what coverage is affected here? So as I say, all applicable employer coverage, what does that mean? Okay, what does it represent? So these first three are the general terms, definition that is used to define what applicable employer coverage is. So generally, it is coverage found under a group health plan. So an employer-sponsored group health plan, right? Okay, so that's kind of no duh. I think we all kind of get that. The second here is coverage made available to an employee by an employer. You might look at that and go, well, yeah, duh. I mean, okay, so an employer is offering benefits and medical benefits or other benefits to the employee. Oh, well, wait a minute, Steve, you You just took that from a group health plan, a medical plan, and maybe into more, right? Possibly, yeah. So coverage made available to an employee by an employer. Next, as part of the definition, is also coverage that is excludable from gross income under Code Section 106. So what that is just meaning is that as most employers today that offer a group medical plan to their employees, they will offer the premium, right? The premium is, let's just say, $500 a month. The employee is going to pay $100 a month for that coverage, and the employer is picking up the remaining $400. That $400 as part of the employer contribution is what that is defining. It's coverage that's excludable from gross income under 106. So that $400 is not taxable to the employee, right? So if you just take those first three bullets there, we're basically talking about employer-sponsored coverage, whether the employer is picking up 100% of it or whether the employee is sharing in that benefit as well. But that employer offered or is offering coverage to the employees. Now, additionally, and we'll get into some of the non-applicable coverage, and that will shed some further light here to what we're talking about, but applicable employer coverage also includes health FSA. Doesn't include a dependent care account, but it does include health FSAs, and we'll dive more about what these all mean. So HSAs are locked in that group, AAs, and retiree coverage. All right, so they have expanded actually as ACA, and when you really get into the language of what a group health plan is, basically a health FSA, an HSA to a large degree, not as much, but HRAs, retiree coverage, they're considered providing minimum coverage. They're a group health plan, and so they are also included as part of this applicable employer coverage. One note as we kind of go through this process, again, it doesn't matter who is paying for the, if the employer is paying for it at 100% or whether the employer, I don't want to, let's shift that employee. Regardless of that, a plan would be generally as a applicable employer plan under the Cadillac Tax. So again, regardless of paying, employer or employee. And also, look at one question that I see real quick. In terms of small group, are they from this provision in any way? I've seen that. So there's opportunities here to participate in this Cadillac Tax. Applicable coverage. So one of the things, we should certainly look over this. A lot of the standard accepted benefits that are always listed as part of ACA. Some might be new. As you look at this, you might say, well, there's a couple there that I didn't think or I thought would be included. But basically, there are these. So coverage only for accident, disability income insurance. Also, so your basic accident, disability insurance would not be applicable. That's generally the course of action as before. Coverage issued as a supplement liability insurance, and then liability as part of general liability insurance. Workers' compensation, medical payment insurance, insurance coverage that is secondary or to medical coverage. So really some more of the supplements of plans or coverage that would be out there today. You see as limited medical types of coverage. Policies for treatment, mouth or eye. So that's directly out of the code here. But basically dental and and vision. So generally, dental and vision have been accepted benefits since the start of ACA, and that has continued here with this as well. Coverage for specific diseases, hospital indemnity, or other fixed indemnity. So again, a lot of the, if it's a fixed dollar coverage for a specific disease, what have you, critical illness of that nature, those would also be applicable coverage. And again, what that means is that those types of plans are not going to be included in determining whether you might have or an employer might be offering benefit that would contain an excess benefit would trigger the specific tax. So who's responsible? On earth is responsible for this? I think it's the broker. No, no, it's not. But we do have to point fingers at someone, and as we look at the responsibility of the tax, I knew earlier that the employer is responsible for calculating the tax, right? So an insurer knows if their plan, based on the premium that they're offering, that is going to create an excess benefit or not. But what that insurer may not know is what that employer also offers, you know, from a health FA, an HSA, HRA, retiree benefits possibly, you know, those other things. So, but who is responsible? So the responsibility of tax, okay, the payment of the tax. So when I say who is responsible, when an excess benefit includes a fully insured plan, which provider is considered the insurer, the HMO. The carrier is going to be responsible for that specific tax, okay? Now, that calculation, I think that'll show here as to what I'm talking about. If it's a fully insured plan, carrier is responsible for the payment of the tax. HSAs and Archer medical savings account contributions, okay, and so focused on employer contribution. The employer is considered the coverage provider. So if an employer is offering an HSA where the employer is offering contributions to that HSA, going to be considered the coverage provider. They are responsible for that specific tax. For all other plans, okay, as it's listed, the definition, and I've just put it in quotes, the person that administers the plan benefits generally includes the plan sponsor, which is generally the employer. Okay? But a person that administers the plan benefits, that could, referring to a self-funded TPA, an administrator, right, for self-funded plans. That could be a person that administers benefits, and so again, if they were labeled the sponsor or the person, the coverage provider, then that specific TPA would be responsible for the tax. Now we all know that as we sit here and say who is responsible, and we're pointing fingers in opposite directions, hopefully away from me, that if a carrier pay the tax or be responsible for the tax, I mean, I would think to agree that's probably going to come back to you, employer, in some form of a premium adjustment of some kind. But nonetheless, the responsibility of tax, if it is deemed an excess benefit, responsibility lies with the carrier. So how is it calculated? Let's kind of dive into this here a little bit. Just kind of hopefully give some good examples, or an example here how this is done. It's relatively easy, okay? It's not that hard. You just need the players involved, who are the coverage providers of all the benefit offerings, and you need to understand which plan that you as an employer offer. Which of these plans need to comply, which fall under this applicable employer definition. So first off, as I've stated before, the determination of the calculation falls on the employer. So the employer is the one that would handle or make calculation each year, okay, on that plan. You know, as you think about this, and we'll dive into it here a little bit more, but you know, again, think about an opportunity for you. How do you get that? Is that something that, you know, you could perform on behalf of the employer? I don't know, just think about that here as we kind of 3-year plan. Maybe it'll kind of come up here and crystallize for you. Secondly here, you know, we need to look at the, you know, what is the aggregate cost of termination, meaning, you know, what premium applicable premium that we're looking at? Are we only looking at what the employee is responsible for, or what the employer is responsible for, or is Cobra Premium? And in general, the coverage determination, so if we needed to figure out what the cost of coverage is for an HRA or for a the FSA or for plan, we typically are going to look at the applicable premium under the same rules of Cobra. There is a basic formula. Okay, again, it's not rocket science, just a matter of getting you introduced to the product. So we have self-only coverage. The threshold is $10,200. So if you just kind of look, divide that by 12, that means that when we calculate, when we look at the aggregate coverage determination, so we look at all the plans that the employer is offering that's part of or included in the tax calculation, do those premiums contributions exceed $150 per month for self-coverage? So does it amount for $27,500 for all other coverages? By 12, does the cost of the benefits that included as part of the calculation, does that exceed $2,292? If it exceeds those amounts per month on that annual basis, there is an excess benefit in which the tax is assessed. So just taking it a step further, let's down just a little bit more when we talk about the group health plan, and we're now about, well, what's the actual premium amount that we're using? What's included? Okay, so let's dive in. Said for the group health plan, well, the Cobra, what's the Cobra premium? And that generally is just the standard monthly premium, right? That the insurer is charging that particular policy, and but you need to include employee share and employee share in the calculation. Okay, so the group health plan, that medical benefit that's offered, whether fully insured or self-insured, you want to look at the full premium, regardless of who's paying for it. Secondly, then, is the health FSA. Is included as part of the premium, if you will, is employee and employer share of contribution, so of the total. So if the employee put in their $2,500 and the employer did a dollar for dollar match up to $2,500, that's $5 that for annual that would be included as part or go toward calculation. Maybe the employer doesn't contribute at all to the FSA. In cases that is the case, then the health, we would only look at what the employee is contributing. On the HSA, it's the employer contribution. Okay, so you have both employee option, it's for an employee to elect to provide more benefits to their HSA amounts, and the employer can make contributions as well, but only contribution is, at least there's a lot of opinions right now, that is where the focus is. I guess I should ask that, because there still needs to be some definition behind some of the language that they had put out here back in 2010. But HSA, I think a lot of it would be around that it's focused on the employer contribution. And then an HRA, 100% employer funded, you would utilize the Cobra Premium, because you create a Cobra Premium, and HRA is a qualified plan, and so you would utilize the Cobra Premium amount, which does from year to year based on utilizations, be a large amount, that very small amounts, okay? And then lastly, you mentioned the thresholds of the $10,500, $27,200. Thresholds are a little different. They wouldn't make right? But a little different for these two, I guess, these two areas, okay? So first off, the threshold can be adjusted. I think what they have stated in the regs is that, you know, they've come out with numbers, these thresholds, but theoretically, the numbers, these thresholds change just based on potentially medical inflation. That could be one way thresholds would change by what we know today. Next could potentially be age and gender. So the age and gender mix of plan participants, the amounts could and vary by plan. So they could come out in 2018 or before that, but that based on certain age and gender mixes within the plan, that your threshold would change off of these originals. And then there's also a threshold change specifically for qualified retirees and also high-risk professions. Okay, high-risk professions are those enforcement officers, fire activities, you know, emergency, you know, ER, out of hospital, like emergency medical care, mining, construction, all of them, okay? And if an employee or a group of employees fit into those categories, then the threshold, at least as it's stated right now, would increase by $1,650 added onto the $10,500 for self-only coverage, and then an additional $3,450 would be added for all coverage on top of the $27,200. Okay, so just note, little we think about calculations and thresholds and determine the tax. You know, those factors are in place as well. Okay, so it's easy, but you know, there's to it than just a real simple calculation. So let's look at an example. I'm hopeful that this will, as you look at this, it'll kind of just shed some on handling and kind of figuring out this calculation. I'm using this example, and some of you might go, "Oh, come on, Steve, you know, really, or where'd you get these numbers?" Anyway, just so let's say we have an employer, 50 employees, so good sized. They offer an insured medical group health plan. And let's say, actually in 2018, all right, the cost is $700 per month or $8,400 per year for self-only coverage. Okay, so I'm just going to example as self-only coverage. The employer does this plan, this medical plan, is a HSA compatible or qualified plan, let's assume. The employer is making an HSA contribution of $1,000 per year. The employer also, because it's a deductible plan, all right, and in 2018, I don't know, who knows where deductibles might be, but the employer is offering a post-deductible, which is allowable under HSA plans. So it's kind of at the tail end of deductible, that when we look at the Cobra Premium for that HRA, the Cobra Premium results premium of $2,000 per year or $160 a month for self-only coverage. Okay? So this is this could be a legitimate plan offering from an employer, and run the calculation. So for single-only or self-only coverage, the threshold is $10,500, so keep that in mind. We have $8,400 health plan. We add the employer contribution to the cost as well. So regardless if employees are making those contributions, looking at that, only what the employer is. The HRA, 100% employer funded benefit. So we also attach the $2,000 as the Cobra Premium HRA as well. So we add those up. We get to $11,400. We then take $1,400 minus the $10,500, and we get $900. All right, and so we have an excess benefit per employee. So that's yearly. So I've broken this out on an annual basis, and hopefully, if I did my math math right. Hopefully we'll have it correct. But it is an annual, that's an excess benefit for the entire year, all right? And it's, so 9 times the 500 is $4,000. So if we take all those employees, if all those employees were in the medical, had the HSA contribution, were participating in HRA, then it is the $45,000 for the entire year. So that $4,000 is above the excess benefit. You then apply the tax of 40%, which is $1,000. So basically what we have, so we have $18,000. So what happens here? We have the result of $1,000 excise tax. It will be allocated to the providers of, so the employer was responsible for performing that calculation, but of that tax will be allocated to the employer. So this particular employer offered an insured medical benefit. So the allocation, you know, let's say, and I didn't run math in my head, but that 8,400 might represent, let's say, 3/4 of the share. Okay, so the medical benefit carrier would be responsible for that allocated share of the tax, but the employer offered an HSA and HRA, so therefore the employer would be responsible for tax specifically for specific benefits. Okay, so you know, just in looking at that, you know, hopefully that helps kind of paint a picture. If I have made any mistakes in my calculation, I will review it again. I send it out to you guys. It'll be perfect, but hopefully at least the spirit in the numbers. And you kind of see how, as the employer does actually utilize or perform the calculation, how that is going to have to be made, right? Okay. What is the penalty? Some of the questions that you know, hear a lot too is just, so at the end of the day, I mean, what's the penalty? What are the occur on this? Basically, if you look at the last bullet point, it gives away. I mean, basically, the employer is going to need to still pay the remaining tax. I mean, if you look at okay, there's $18,000 size tax. If the employer, when they performed their calculation, they only calculated 10,000 when it should have been 18,000. Based on this penalty here, the employer is still obligated to pay the $8,000. Again, allocated between the coverage providers, but that $8,000 would still be due. The difference would be in this first bullet point, says, you know, with interest for the period. So they would be responsible for the penalty, in essence, each amount of the tax underpayment. So that would be the additional cost if they underpay. That could be pretty serious, right? I mean, to run the you know, the appropriate taxation. I mean, you're going to want to make sure that employer might want their CPA check some numbers. You might be involved in some of those numbers, but it will be very important here gets the calculation right, and that they properly look at that allocation. Whom also should participate in that particular tax. So a lot of the nuts and bolts of the tax is how I had laid it, and I'm already seeing a lot of great questions coming through, and we'll be able to maybe take a little deeper dive with some of those questions in AQ when we get those. But let's turn, and I want you to think here a little bit, because planning is critical. You know, you just start or begin planning with your employees today, and I want to, hopefully I'll show you why you should. So first off, you need to have some comparisons. You need to have something to go off of. Your employers are seeking advice from you. You need to be able to kind of share, listen, employer, your premiums are here, you have these kinds of plans, but, the benchmark says that you should probably be at a much lower premium plan. You should be in HP, not a PPO, be good to kind of benchmark where versus kind of the average out there in the U.S. So the next couple, I have pulled data here from the 2014 United Benefit or UBA Health Plan Survey. I love it. It is the largest survey of its kind. I think they state something like it's probably 2 or 3 or 4 times more of employers than any other survey that. So the statistics, the measurements on this is an excellent report. I would highly recommend that take a look at this particular survey. Responses are based on over 10,000 or close to 10,000 employers, 16,000 health plans nationwide. So you say, Steve, what are you doing? Okay, so why are we going into a survey here a second? So before we get into our 3-year plan, let's kind of drive some perspective. All right, so nationally, out of that survey, 55% of the employers, okay, that surveyed offer only one plan to the employees. Think about that. Employer base. Think about your groups that you deal with. I would, for some of you it might be skewed to the other, but I would assume that about half of your employers, that more, offer only one health. Well, that's interesting because, the Cadillac tax, we should start maybe calculations right now just on that specific health plan that they have and determine whether more health plans need to be. So we'll take that a little bit further here in a second. So 55% offer only one health plan. So that's interesting. 14% of plans offer 100% coinsurance. So still a very large amount of plans, it's dwindling, but still quite a few plans that still have a coinsurance, which is going to, of course, in a richer benefit and a more costly benefit. 20% of plans no in-network deductible. Now, I think for those of you in the Northeast, you got that going, that's great. No, actually, plans in the Northeast actually have the richest plans and the most expensive plans. Maybe those in the West are actually, that's crazy. Every network deductible, right? So here's some figures, okay, and kind of just throw out there. So, and you can look at these, but I want you to think about, so you've got 55% of employers offering plan to employees. So as you think about your groups, which of those kind of apply with that? Now, what type of plan do they have? Now kind of run in your head as the plan they offer. Is it a PPO, HMO, POS, an EPO? I know a lot of EPO, but they're the most expensive out there. And where do they sit? Do they offer a CDHP? One plan that they offer just a PPO? That PPO costs on average roughly almost $1,000, $900 more than a CDHP plan. So we're going to kind of look out 3 years from now if that truly wants to keep that PPO plan, that POS plan. So plans, certainly there's been a prevalence of CD plans being pushed out. Roughly 30% of employers in the Northeast offer a CDHP plan of some. When I say CDHP, it's an HS, it's an HRA type of an account-based plan. When I say it in that regard, and then going all the way down to the West, about 50% of employers offer a CDHP plan today. So what to show you here is that there is real opportunity, that there's a great number of employers that have not yet adopted CDHP plans. It could be an avenue that you could take to reduce the exposure of the Cadillac tax. Okay, so we'll do that here. Also, what I want you to think, cost increase, it's fairly easy. It's only 3. Calculators are pretty astute now at calculating rates and points over a certain time. But if you just do some math, simple math, average total cost of a CDHP plan today, again, this is the average, so 88,919 based on that survey. I'm assuming an 8% inflation rate on medical inflation rate, not a general inflation rate. Keep in mind, some of you might go, Steve, 8%. Really? You know, some of you right now are so low or it's too high, right? I did my best to give a good number here for, but 8%, that 919 grows to 11,200 average annual premium. Now that's an average. That's not an average. That's not an average of the covered. That's just taking all of the health plans offer. The average premium is. So depending on your region, you're going to see a number much higher. Another region may be much lower, right? What you also want to keep in mind with this 2018 at 8%, the average goes to 200. Keep in mind that including other benefit options that would fall on this particular tax as well. So you have HSAs that would need to be considered, HRA, FSA contributions as well. When we throw out these numbers, not necessarily throwing in additional benefit plans that are going to count that aggregate total cost. So how can you begin to control health plan, right? So let's just think about this. And this is a great slide, I think, that touches on key items that you could begin to review and discuss with your employees. Some plans, now I mentioned that a dental and vision plan, that's not included, it's an accepted benefit, it's a non-applicable clear coverage, okay, based on this tax. But plans, medical plans include, other than those mandated, but include maybe additional and or vision coverage that is offered through those. What if you were able, again, just ideas, could you change the way that that dental and vision coverage is offered in that full group health plan, right? Medical plan. Could you remove some of that, change it, and maybe reduce some of those costs? You could use additional cost-sharing strategies that really influence utilization. Cost-sharing strategies like HRAs, utilizing HRAs or APs that you could move, move the election or enrollment in particular benefits by just changing cost-sharing strategies in how deductibles might be reimbursed or what. You might want to begin to look at the potential of narrow networks, looking at hopefully, maybe they love the plan. By reducing providing a more narrow network, it would actually lower the cost further. Possibly self-funding, avoid some of these additional costs or get you below the threshold, and by moving to self-funding, not for everyone, but what a great talk track today to begin to really get your client to become more confident in moving toward a self-funding vehicle by these conversations, and it might avoid these additional costs. You could also relatively easily revisit payroll contributions to maybe drive employees premium plan. So you just change the payroll, the employee share of that B, and that might move them to other plans. Eligibility rules, it's getting really defined right now in regard to eligibility, but there are some employers, they operate where they might be able to reset different eligibility provisions that would enable to reduce the exposure or the number of employees who are eligible for benefits. Having your plan with employers right now could also step up and really focus on wellness initiatives. I know it's always tough for employers to really want to move in this direction, but given the type of benefit they wish to provide or would look to provide in 2018, there is no better time present to step up efforts or begin to take some early steps of creating wellness initiatives, because employees, right, can be better exposed and a better understanding or have a better understanding of how to utilize their health benefits, well, guess what? Maybe claims lower in 3 years, so that premiums will be lower and maybe help reduce the hitting that threshold or going over that threshold. And then also just the approach to account-based. As I mentioned here, CDHP plans and still represent a small part overall of exposure in the U.S. wherever you are. So you might want to adopting, implementing certain account plans today to help reduce that overall threshold. So let's look here at kind of a 3-year strategy. As we kind of narrow down our focus, our webinar here today, let's look at this here. And I put a yield sign here. I put a yield sign is because you do forward. You want to move forward and having a conversation with your employers, but you're going to do some caution, right? Changes, as I mentioned earlier, can be made to the current structure of how this excise tax is going to be delivered. Absolutely. I mean, who's to say that it won't be delayed, further? Who's to say it just doesn't change? The thresholds are increased a whole lot more so that a lot of this tax, or it's reduced, goes the other way. I mean, there could be a that will factor in change. So I just put that yield sign to say, hey, you need to proceed. You do need to start your due diligence. The same token, there will be changes. So in 2015, I mean, many of you who have already gone through, or employers who have gone through January 1 renewals and February 1 on to March 1 renewals, maybe it's too late, right? Possibly. But begin to run calculation of the applicable coverage. Let's figure out what their baseline is right now, because that base is going to tell us, okay, if we take, if we assume percent inflation growth then on that cost, I mean, if all things are being equal over the next 3 years, here's what your looks like. Here you've exceeded, you have benefit, or you do not. Okay, so run that calculation today. Suggestions that 2015, if indeed the survey is correct that 55% of your only offer one plan, if it's a rich plan or not, you might want to begin adding a CDHP plan to the mix, right? You might want to begin encouraging changing employee funding strategies through payroll or through account-based strategies to begin to push, incentivize employees to move to a lower plan, into a CDH plan, maybe in. You might want to begin discussion visiting networks. Are there options for you, employer, to look at narrow networks, do some of these costs? If the employer is on board and you've been able to have a discussion about wellness, boy, looking 3 years out, getting employees, to speed in wellness, to create a habit. So start those wellness initiatives, handle it today. Evaluate account options. That clearly is going to be something that you visit. Are they currently using H and HSAs? Are they contributing to HSAs, FSAs, and so forth? So in 2015, again, like you said, you might have already missed the opportunity to make a change here for this year to some degree. So you're going to continue to run the calculation, but you're going to want to begin to encourage utilization and start an employer contribution to an HSA. Most plans out there today, a very large number of them are HSA qualified plans. So in order to get employees to start contributing to an HSA, a great way to would be the employer making contributions. Well, how about this? You could start having a 3-year period where the employer starts out with a larger into everyone's HSA now, and for 3 years diminish that. But what the employers will do is get employees engaged, understanding the benefit. They know how to use they're comfortable, they're confident. So by 2018, maybe the HSA contribution to employer is no longer needed, and the employees are just contributing, into that. So encourage that contribution today. Get them started. Depending if you're fully, you might want to clearly start getting self-funded options in 2016, or maybe vice versa. If self-insured, evaluate fully insured plans. So it just depends. I mean, where you're at, you need to look at, I think, both sides of the aisle. Begin to have that conversation. You might want to start full contribution strategies to encourage more lower cost plans. I think it's critical that employers will want to move just one singular plan. They probably will want to have plans, you know, a low and then a buy-up, or whatever it may be, but encourage kind of a movement to those lower cost, avoid that threshold. HRAs will continue to be used widely to become one of the more highly enrolled benefits, you know, a kind of a key option for these. I mean, in order to really attack that threshold, a CDH plan is an excellent vehicle to do that. My hope is to create these strategies that wellness becoming more engaged with. Maybe the employer is to additional incentives to move it from just a baseline, take a health but coaching are involved to really drive the wellness and make it active. At this point in 2007, HSAs and HRAs will absolutely be managed as it relates to the aggregate cost of the coverage. So you're really going to be you're going to want to look at those HSA contributions and the premiums there in order to determine that cost and how an employer might want to gain, reduce, increase those particular benefits accordingly. In 2008, total aggregate costs create excess benefits. Some ways to potentially remove that would be, you know, moving the HSA employer contributions, maybe put those in wages, you know, instead of it into the HSA. Now, that's not great because taxable, but you know, certainly could be an option, and hopefully that employee would take those additions and maybe put them right into the HSA. We're on a 3-year plan with them. They might be very accustomed to putting those dollars right into the HSA. You might look to reduce. And an easier way to remove the excess benefit would be to reduce the exposure in HRAs, at least that employer contribution. Employer might take an aggressive measure to offer only plans meeting with the thresholds, right? So an employer just might say, you know what, I'm just not even offering a plan. I'm not offering a POS plan. No, it's the thresholds. I'm not even dealing with it. You know, I'm going to stick with those plans well within the threshold. Lastly, you know, maybe you're self-insured. Tax would be responsible by employer if it's fully insured. Not that it wouldn't come back to you, employer, but you know, maybe there's 2 fully insured plans to kind of share in the cost. To note, beyond 2018, the thresholds will increase based on general inflation, not on medical inflation. And medical inflation trends are roughly about 3 times the rate of general inflation. So what does that mean? Well, it actually means that it's going to result in a higher tax amount. It means that if this thing would have been to medical inflation, we would actually see a better alignment of meeting these thresholds and employers not expecting to hit the tax each year. But with medical inflation going 3 times the rate of inflation, this will result in greater strategies needed by every employer because it can result in high amounts down the road. So just lastly here, as I've mentioned, for. I trust that this content was helpful. Time for action is now. You want to get your employers across the finish line. Finish line just keeps going, okay? I don't know if you could sit here and say the line, but you have 3 years or roughly 3 years to your clients in taking really a hard look at each of the benefit plans that employers offer, that you study, account-based plans, you ensure they're on the right path. You know, run that count now. Don't wait another or two before you really start monitoring that. I say that because super high value activity. This is great activity for you. If you sit down with your employer and really strategize and think about the future for them, your employer will thank you tremendously for helping them. Because this tax, could it end up being just a crazy, crazy amount? I mean, it could if you don't monitor today, but it's just this additional cost that is non-deductible, right, to the employer. So if you can create activity that would enable them to easily get over that finish line in 2018, they are going to be extremely thankful of a client for life. So that concludes our here for today's webinar. I can't thank you enough. The questions just fly through. So what we will be doing is providing an FAQ here. We'll put together all the questions, provide the answers, and we will be sending back to you here as of the next couple days. So here on Thursday, by Monday or so, we should be able to get that information. We will also getting you the link to the recording, but you can find that right on our BrokerCon YouTube channel, and we'll also provide you. So think about the Cadillac tax, how you can address this, how your agency, how you impact your clients with this important, significant revenue provision of ACA. Make sure that your clients know about it today. Plan today. They're well positioned for when this thing takes. So with that, I want to thank you for attending. I really appreciate the comments everybody has made and the questions that have asked, and look forward to our next week here in March. So for those of you in the Northeast, stay safe in that snow. The rest of you, well, actually a lot of you are impacted by that snow. Safe out there, and we look forward to our next week with you. So have a great day, and this concludes our webinar.